Reduce retirement risk by buying stock on margin? What? And these are Yale professors? Oh my goodness, Finney smells a piece of bacon. He's inside his little nosy. Anyway, this article 100% makes sense. It's dated from 2008. I'm not sure if these professors would still buy into this. I actually imagine they would, frankly, because the logistics, the logic behind it makes sense. What are you doing, buddy? Come on, you want to say hi to everybody? Want to say hi? Come on, you want to say? He's staring at this piece of bacon. Look at him. Look at him. You're trying to get that bacon, aren't you? You're not getting it. Look at him. He's like, sees that bacon. He's like, I gotta get that, Dad. Yeah, he already stole 2 eggs from me today, didn't you, knucklehead? Yes, sir. All right. Anyway, so let me show you this article I'm reading here. So how did I come across this? I came across this from this article, the 100% strategy, which came across from this article, Pablo, which came across from this article that my man, who sent this to me? I forgot who sent it to me. Let me, hold on a second. Excuse me. Let me see who sent that to me. Excuse me. Well, Timothy, he sent this article to me. So when we're reading articles, we want to read also the links that go with it as well. That's where you get a lot of the better information. Anyway, so this is a good article. It's from Hildy and Stan Richardson with Scarsdale Investment Group Limited. All right, and a short commentary of the current risk of stocks and bonds, and it's very interesting. Lots of good stuff in here in terms of problems on the horizon, and he even cites economists, which I can't stand. But this is actually a good piece of writing from the economists, and just a couple weeks ago. Now I want to share with my man Chris is out there. Chris, you know what I'm talking about. All right, so right here, and we're going to go back to my main argument in just a second. The problem when deciding between a 60, 100, or even 200% equity allocation, a 200% is what the professors from Yale will talk about, and we'll show you how I agree with them, is that history of financial markets is too short. Arguments on both sides rely either explicitly or otherwise on a judgment about how stocks and other assets perform over the very, very long term. And most of the research which finds that stocks outperform other options refers to the track record since the late 19th century, right? Or even the early 20th century. Although that may sound like a long time, it is an unsatisfyingly thin amount of data for a young investor thinking about how to invest for the rest of their life. To address this problem, most investigations use rolling periods that overlap with one another in order to create hundreds or thousands of data points. But because they overlapped, the data are not statistically independent, reducing their value if employed for a forecast. I could not agree with that more. Chris, you out there? Because they overlap, the data are not statistically independent. Thus, there's just not enough. We don't have enough individual time frames to say, hey, statistically relevant probabilities going forward. We just don't have enough, man. We can presume and we can forecast all day long, but we don't have enough evidence historically to say, because this is a good chance of that. Man, it is dark and cold and rainy out. It's not cold, but all right. So let's keep going back to this. So, in fact, I'll just kind of go back here. Where did I get this article from? Right here. A portfolio solely made up of stocks is likely to beat a diversified portfolio. But why stop there? Although the idea might sound absurd, the notion of ordinary investors buying on margin, borrowing to buy on margin, is considered normal in the housing market. Some advocates have a similar approach to the stock market, as Ian Ayres and Barry Nailbuff. And there's Ian Ayres and Barry Nailbuff right here. Life cycle investing and leverage. Buying stocks on margin can reduce retirement risk. And I completely agree. In fact, they even cite Schiller. Look at the old Schiller. Provide helpful comments. Schiller from Yale. You got Harvard Law School, University of Chicago, Stanford, Yale. You don't want to challenge the academic experts, do you? I mean, I'm just me. I haven't shaved. I'm still in my same t-shirt I wore yesterday. Don't understand the people say, you're wearing the same shirt. Dude, I'm in the house. All I did yesterday, I went to Costco. I went outside with the dogs a little bit. Yeah, it's okay to wear the same t-shirt. Normally, I wear a t-shirt underneath this shirt anyway, but it doesn't smell. Just smells like your old buddy Josh, which is like peaches and cream. Ooh, you smell like peaches and cream. That's why the ladies love me. But they don't. They don't. There's no lady who wants to get frisky. And she knows who I'm talking about. She knows who I'm talking about. Frisky is the word of the day. All right. Anyway, so right here. By employing leverage to gain more exposure to stocks when young, individuals can achieve better diversification over time. Using stock data to go back to 1871, we show that buying stock on margin when young, combined with more conservative investments when older, stochastically, and I don't know what that means. So we can look at it. They use this all the time, and I just can't. No, let's just look it up. I don't want to look it up. Stochastically dominates standard investment strategies. I always forget what it means. Dude, it's pouring out, man. Yikes. Look at this. Let me show you outside my window. Does it bother you, my ADHD? I've never been diagnosed for ADHD, but I also never been tested for it. Look at that. Pouring, dude. Pouring cats and dogs. Meow, meow. Meow. He's waiting for me to leave so he can try to get that piece of bacon. Just stay on point. All right. Using stock data to go back to 1871, we show that buying stocks at margin when young and then making it less aggressive when older dominate standard investment strategies. The expected return of retirement wealth is 90% higher compared to life cycle funds or 19% higher compared to 100% stock investments. The expected gain would allow workers to retire almost 6 years earlier or extend their standard of living during retirement by 27 years. So this is kind of weird. So life cycle funds, we talk about, I think they actually got a note here about that. Fidelity Freedman funds and Vanguard Target Retirement funds start with 90% in stocks and 10% in bonds and gradually move to 50-50 allocation. All right. So, and then they're saying, so if we just had a leveraged portfolio, we would have 90% higher wealth compared to those target date funds. Or if we just did a levered portfolio with 19% higher compared to 100% stock investments. And I'm not going to read this whole paper. Share with you what their gist is. The point of this paper is to overturn the standard orthodoxy that counsels against buying stock on margin. Most people, including ourselves, this is the authors of the paper, misinvested their retirement portfolio when young. The cost of this mistake is not small. Our estimates suggest that if people followed this advice, historically they would have retired with portfolios 21% more on average compared to all stock and 93% more when compared to the life cycle strategy. Well, I thought they said 19% of it. So why they got the numbers wrong? That's kind of weird. Yeah, they did say 19%. That's kind of why they. Whoa! Hear that thunder? Yikes! The dog's getting nervous. Not Fenny. It's just thunder. Just thunder. These gains could be socially significant. Some other authors report that in 2000, life cycle funds had $5.5 billion in their assets that grew to $47 billion by 2005. So they're talking about this is not a small issue. All right, that's fine. And this is exactly what I did. I used to borrow against credit cards that I paid 0% interest for the life of the credit card loan and put that into my Roth because I said stocks will give me higher rates of inflation. And essentially that was leveraging because I didn't have the cash flow. I didn't have the cash flow to put. Back then, I think it was $2,000, and I can't remember. They increased every year. I did not have the cash flow to put $2,000 in one fell swoop. So I just said, I'm going to borrow from my credit card and I'm going to borrow essentially from my credit card, do a balance transfer to 0% loan for the credit card, and I'm going to do that. And I did that for 5 years or something like that. So between me and my wife, we had roughly $20,000 invested in Roth IRAs from borrowing. And we happened to do it actually even at a better time when the markets were going down in 2000, 2001, and 2. So we were buying low. All right. Now what happens is that $20,000 we borrowed, I can't remember what it grew to, maybe $50,000. I just don't remember off the top of my head. You still got to pay some of that money back. So you're paying it with your cash flow. All right. And you got to, let's just say 1%. I can't remember what the terms were. Let's say $100 a month, whatever it is. You know what I'm saying? So you still got to pay that $100 a month, $200 a month. I just can't remember. Generally speaking, I think it's 1.5. The minimum payment is like 1.5 of the outstanding balance or something like that. Either way, we'll just say $200 a month for simplicity. All right, so I still had to pay $200 a month on these credit cards. All right, now that's fine when your income can support that. What happened to your old buddy Josh the latter part of 2007 and 2008? Well, actually not the latter part, the beginning of 2007, because I could see it. You could see these guys who are heavy freaking real estate investors. They were starting to, you're talking with clients, man, who are real estate investors and real estate contractors. They were in a world of hurt, dude. And it wasn't happening in the financial markets yet, but they were in a world of hurt. They weren't just as crazy because they're so heavily leveraged. Well, then lo and behold, it hit the financial markets. So what do you think happened to me? Well, my job was on the line. I mean, it's only a matter of time before I got let go because my performance was freaking sucking wind. And so if you weren't making the firm $250,000 a year in gross dealer commission, basic commissions, which you only got 30% of, by the way, they're going to let your butt go. And I wasn't, because I didn't have it. I was building assets, but I was building assets and fees that are based on the asset, the amount of the assets I had. Well, the assets are dropping by 20, 30, 40% because the market's on top of that. People are getting nervous and they're pulling their assets out to stop the bleeding. On top of that, other people got the debt they got to pay for, so they're pulling money out to pay off their own debt. So what I used to have about 25 million of assets under management quickly went to like 13 million. I'm making roughly 75 basis points on 13 million. That's not getting the job done, dude. Not at all. On top of that, I'm still prospecting for more assets and other people. It's just this vicious cycle, just falling. It's like the snowball effect. It starts slow and then zoop. Anyway, so my salary was just being destroyed. On top of that, my job was looking scarce. And it wasn't just me, many people in my industry, many people, man. And then finally, on top of that, I still had my debt to pay because I still owed that money. You see what I'm saying? I still said, well, if I have 0% interest, I'm only going to pay the minimum monthly payment of $200 a month. So basically, if I'm paying $200 a month over the course of 3, 4, 5 years, I'm paying it down, but I'm not paying it off. And then all of a sudden, out of nowhere, I can't remember how much I had, but all of a sudden, out of nowhere, man, kaboom! They dropped the hammer, the credit card companies. Now it wasn't 0% for the life loan anymore. It's 14.99. I will never forget that. So we just moved to Texas to take this new stable job with USAA that's paying like $80,000 a year or something like that. And I was like, thank the good Lord, because we were two new babies, Irish twins, born in the same calendar year, but not regular twins. That's what Irish twins are called. And they're both in diapers. Maddie was 8 years old. Chloe was 5 years old. Young kids. Charlotte wasn't working. Had a mortgage. We're heavily, didn't have a whole lot of equity in our home. Woo. So that strategy worked until it didn't. If you would have done this strategy in 2009, dude, you are freaking crushing. The question is, who knew in 2009? Now, on top of that, you're sitting there thinking, you didn't know in 2009 that 15 years later, you would have freaking averaged 13 or 14% a year rate of return? You did not know that. And every year the market does fall. And every year it falls a little bit, say 14%, you're flipping out, dude. Even though it came roaring back, you're flipping out because you still have that debt. I tell you, man, the best strategy for retirement is not to have any debt. That's all there is to it. The best strategy for pre-retirement is not to have debt. When you don't have debt, you can travel light. When you have debt, because the banks, they say, hey, you owe us money. We want it sooner than what we anticipated. And you got to pay up. You're like, yeah, but that wasn't what I thought. It doesn't matter what you thought. It's what the freaking red tape said, the small print. The small print said, you got to pay. And you're like, I can go bankrupt. You don't want, in my business, you can't go bankrupt. I mean, you can, but you'll never work again. You don't want to go bankrupt. You know what I'm saying? Really. Anyway, so they're right, these guys, but man, I tell you what, you gotta have kahunas of steel, if you know what I'm saying, and I don't. Not when I got kids, man. Not when I got kids. Maybe if it's just me, I could do it, but anyway, all right, love your thoughts. God bless. We'll see you.